December 21 was an exciting day for us. The Singularity Strategy reached its 3-year track record. And over this period, the strategy had a cumulative return of 75% and outperforming global equities by more than 40%. And the bulk of this outperformance came from stock selection, and that's what we like to see. By design, the Singularity Strategy has companies in the portfolio that have a relatively high Singularity Score compared to peers in the same sectors. And why should we care about this? Well, because companies with higher Singularity Scores outperform those with lower scores on a sector neutralized basis. So really comparing apples with apples. If we plot the top 2 quintiles of Singularity Scores in the global equity universe against the bottom 2 quintiles, we find a significant outperformance of more than 25% over the last 3 years. So not only is it important for companies to adapt new technologies leading to a higher Singularity Score in and itself, but for each sector, it is crucial to find those that apply new technologies in their business models. Indeed, it's a question we often get asked, and we compare ourselves against global equities and the global benchmark MSCI All Country World because when we look at our investment universe, it's largely shared with the MSCI All Country World. Roughly 90% of the companies in the Singularity Strategy can be found in the MSCI All Country World. Therefore, we think it's a good benchmark. Now, if we look at other indices such as the S&P 500 or, for example, the NASDAQ Composite, the overlap is much smaller. About 2/3 of the firms in the Singularity Strategy are not represented in those indices, meaning that there's only about 1/3 of the names that overlap with these benchmarks. In December, the fund was up more than 5%, bringing year-to-date performance to 34% for the year, which represents an outperformance versus global equities of 18 percentage points. And the assets under advisory for the firm have now reached more than 55 million.